KKHT wants you to meet three of the classiest guys in real estate.
I am Chris Kelso, the maestro of mortgage.
I am Rob Cook, the godfather of real estate.
And I'm Joe Orsak, the king of credit swing. And together, we're
the Real Estate Rat Pack.
Much like us, real estate right now is smoking hot. So whether it's buying, selling, or owning, you need to check out the Real Estate Rat Pack.
They're here to take your calls and answer your questions live. Call now 1-800-808-5548. And now, the Real Estate Rat Pack!
Hey, we already did it up this morning.
I know.
That was actually a good. I think we gotta start going with that from now on.
That was pretty good.
That was really good. We start off with the and then you go the who.
Build up. Yeah, absolutely.
You know,
every week when I watch the audio back, that section always cracks me up because it's this big, massive spike of sound. I always know where the where the howl is at.
You know, and speaking of howling, we're going to be howling out to Rob Cook, who's not in the studio today. He's actually having a good time.
Little time in county.
That is correct. He's doing a little time in county out there called San Antonio.
Yes.
Or what they call TAR for the Texas Association of Realtors, if I'm not mistaken.
Yes.
So, Rob, big shout out to you there.
He's getting his tar on.
That is correct. It's always important to get your tar on. So, but we're going to miss him here in the studio today. And, one of the things that we're doing for all those listening is we're going to be talking today, believe it or not, about credit and mortgage. That is the entire subject matter today. We also might have somebody stopping by, give us some of those hand-rolled cigars later on today.
I think that's a possibility.
That's a possibility right there. And I love your shirt, by the way.
Thank you. It's
a great shirt. It actually was provided by Lucho's.
Lucho in the Galleria.
And that is always good stuff right there. But you can reach us at 800-808-5548. That's 800-808-5548. And again, we're speaking all about credit and mortgage. And one of the things I want to start off with is from a credit standpoint. One of the things that we talk about all the time, Joe, how is credit established and what consists of developing a credit score?
Well, it involves some magical beans and coconut oil, the right temperature. Oh, I'm kidding.
And the coconut oil, exactly.
Well, building positive credit, building a good credit score, there's actually 5 areas that really are the large areas that break down into many, many, many specific details after that I won't bore everybody to tears with. But the process of building a good credit score is broken down into 5 categories. Kind of a shocker for most people that if you think, what determines my credit score? How is my credit score created? Most people
it's just not an algorithm they put out there, and then, you have to go pray to a certain, credit.
It's about that way. It's about that way. The formula that they use to determine a credit score is probably more secretive than the Coke formula.
Right.
Nobody knows. Even within the organization itself, there's different teams that work on, they're called scorecards or cards, where their set of algorithms are determined. So that team only knows their set of algorithms, and there's 18 cards. And 18 different teams. So
right.
It's highly, highly secretive, which, if you think about, does make sense. They don't want anybody manipulating their behavior to take advantage of the score to increase the score falsely.
Right.
The score is supposed to be just an indicator of risk. That's all it is. So when a lender or a creditor is considering extending money to you, they look at those 3 little scores, and they are able to, from those scores, determine how much risk you represent in loaning money.
Correct.
So that's kind of the overall, big idea. The thing that kind of would throw people, if you ask the average person walking the street, what do you think the number one factor is that determines your credit score? It's not rocket science. Most people get it, right?
Right.
How you pay your bills.
Yep.
That's not a big shocker. Pay your bills on time. You've got the number one category covered. But the thing that does shock a lot of people is when you ask them what percentage of their score is determined by paying their bills on time. You would think, and I usually get when I teach classes, I get answers all the time, 50%, 60%, and logically in your mind that would make sense.
Right.
You would think that, hey, how I pay my bills is going to be the biggest indicator of what creates my credit score. But the shocker is that only 35% of your score comes from how you pay your bills.
And it's still the largest portion,
It's
but
the-
you know,
it's the largest
still the largest
portion.
portion. But when you have 6 factors
Yeah.
to consider, really, in making up a credit score, 6 key factors or 5 key
yes.
factors in making up your credit score. It's a large percentage, but really, in the overall aspect of things, people sit there and go, "I pay my bills on time."
Yes, exactly.
You know, isn't that what the measure is supposed to be of?
Exactly. And so when you say only 35%, to kind of drive the point home, I say that means that there is 65% of your score that's being determined by something other than how you pay your bills.
Right.
And if you don't know what those other factors are, you have exposed yourself to 65% risk.
Right. And some of those factors being, for example, the amount of credit you're using.
Correct.
So you can be paying your bill absolutely on time. But if you have it maxed out, for lack of a better word, if you have it, to the limit of what your available credit limit is, that's a factor associated with a lower credit score.
That's a huge factor. In fact, that's the second category, which is, for me, as the biggest shocker when you add, teaching this class and teaching this kind of material. We get to this one, we say the second factor, and sometimes people are savvy enough about their credit that they will guess that, it's, hey, the amount of debt that I carry is probably the next, indicator of my credit score. That is the second category. The part that's shocking is that 30% of your score comes from the amount of debt you carry on your credit cards.
Wow.
30, that's only 5% less than how you pay your bills.
Right. So you have 65% of your credit now determined by 2 factors. Number 1, how you pay your bills, your timeliness of pay. And then number 2 is how much of your credit you're using in proportion to what's available to you.
Specifically that revolving credit.
Right.
The credit card debt, that's what it's looking at, credit card debt. So it scores a home loan or an auto loan, installment loans differently than credit debt, revolving credit debt.
And then how about, the third thing, and I don't know if it's the third thing, I know it's one of the things that we always look at from a mortgage side thing is establishing length of history of credit.
That is the third category.
There you go.
You're on track here.
I don't, that's crazy, everything I've gone through so far. But yeah, so the next one is the length of history then.
That's correct. 15% of your score comes from the length of credit history that you have, which here's the kind of a fun thing that we get into when we talked about building credit a second. I think we should, for the listeners, that's an issue for a lot of people is how do I establish credit and get started? If I don't have good credit to begin with or no credit, I get turned down for credit cards. So how do I even begin to build credit? So we'll kind of touch on that in a second. But ideally, minimum 2 credit cards, 3 to 5 is the ideal range.
Right.
You don't want to have more than 5. Well, I run into those folks who say, but Joe, between my wife and I, we have probably 20 credit cards.
Right.
And they have that wallet that folds out and it's,
Yeah.
it drops down to the floor, It's
like the fan.
Yes, exactly. And they've got the Lowe's card and the Home Depot card and the Best Buy card and the, Visa and the MasterCard and the American Express and all these different cards. They're like, well, should I cancel some of these cards? And the answer is always, it depends.
Right.
Because here's what happens is that, first of all, if you are needing your credit score now, immediately, and it's already in a range where you need it to be, then don't go messing with it.
Right.
Right. Because when you cancel those cards, third category, that history, you start cutting off that history.
Right.
You start losing history. So in the initial, you will take a hit in closing those accounts.
Right.
Right. But over time, you will come back to a higher place. And again, it's all about risk. If you think about this, and I got into a debate with another credit expert one time on LinkedIn, and I said that you can have too many positive credit lines.
Correct.
And he just went off on me. He was like, that's just the stupidest thing I've ever heard. You can't have too many, good trade lines, all this kind of stuff. And so it wasn't even like 3 days later, I had a credit report come across my desk, and the number one derogatory statement on the credit report was too many positive trade lines. It literally said that. There's a code for it and everything. So I screenshotted it and sent it to him and said, there you go. But Mr. Credit Expert. Anyway, you can have too many positive credit lines. You're like, well, I don't even use them, Joe. I have them in the drawer. It's for a rainy day in case of emergency and that type of thing. But you have to think about it from the lender standpoint. You have 10 credit cards with $10,000, open to buy on each one. You represent $100,000 potential in debt.
That is correct.
So if there's some life crisis, you're a drinking binge away from hitting Vegas and ended up in Mexico with a Ferrari that you didn't know you bought.
Right.
All on the credit cards, whatever. That's a larger possibility of risk than the person who only has 2 cards with $5,000 worth of limit on them.
Right.
So it's a smaller risk. So you can have too many positive trade lines.
And we promise not to talk about my personal life about that, by the way.
Yeah. So
I thought that was privacy policy.
Yes. So that's the third category, the length of credit history. So if you're that person that has the 20 credit cards, what do you do? How do you approach that? I always tell folks there's a couple different ways to approach it. It's the slow dribble over time of damage, or the rip the Band-Aid all off at once approach.
Right.
If you don't want to take a huge hit on your scores, you cancel one every few months until you get down to that 3 to 5 card range and stick with that. Major credit cards, avoid the department store cards like crazy. Not to offend, all the Macy's and Lowe's and Home Depots out there in the world, but there's a bunch of reasons behind that statement. Just stick with a good Visa, MasterCard type credit card, and you'll know that those all report to all 3 of the major credit bureaus.
Right.
And you keep the ones with the best length of history, with the longest positive payment history.
Right.
That's what you want to stick with. If you do that, the third category, 15% of your score, you'll have that nailed down.
So you've got 80% tied up in 3 main things right there.
Mm-hmm.
The next 2, what are the next 2?
Next 2 is a mix of credit.
Okay.
10% of your score comes from having 2 different types of credit.
Okay.
Installment,
like an installment
credit,
loan, a revolving
right,
loan,
exactly.
et cetera.
So if you have 2 credit cards and a car payment or a house payment, you're covered.
Okay.
Mix. A good mix of credit. They want to see that you're paying on those type of credit lines positively. That gives them a good variation to examine how you pay your bills.
And for a lot of our listeners, the biggest differential, what we see here in the mortgage industry and the credit industry, is what they called secured versus unsecured debt, right? So an installment loan, generally speaking, is a secured debt. What you buy a vehicle, you go out there and buy a home, you go out there and buy something that has a fixed amount of installments for a certain period of time. Whereas an unsecured debt is something like a credit card, where you have the ability to go out there, but it's not necessarily anything that's secured by anything.
Exactly. So, there's some big names in the Christian media that talk about debt and credit and all this sort of thing, and there's various folks who are proponents of cutting up the credit cards and getting rid of the credit cards and unplugging from the credit system.
Right, and you can't do that.
And I would love to have the conversation about stewardship,
right,
and what it means to be a good steward of finances and not using credit.
Right.
Because in America, I think it's very, very difficult to actually be a good steward of your finances and be unplugged from the credit system.
Well, one of the things I'm going to say is we're going to come up against a break here in a few moments. But, I agree with you. I think you cannot be a good steward of finance and be unplugged from the system. Because if you go and try to get an automobile loan or a mortgage or go to Star Furniture or Gallery Furniture or any one of those companies and try to get the best available rate, terms,
exactly,
extended financing, et cetera, you won't get them.
And not only that, but and I know we're coming up against a break here, but it impacts you in areas that you don't even see.
Right.
How much you pay on your auto insurance. Right.
Yep.
Insurance folks will tell you that your insurance isn't connected to your credit score, and that's bogus. It's completely bogus. It's one layer removed. They use a system that gives you a letter grade, A through Z.
Right.
And that letter grade in their system is completely tied to your credit score.
That is correct.
Right. So if you come back as an M in their system, you're like, whoa, you're paying a lot more on your insurance.
Yep.
Right. So it hits you in areas like that. But now, more than ever, it also impacts you in your career.
Right.
I know more and more companies that won't hire without checking credit, won't promote into management without checking credit, all sorts of things. And it's kind of starting to work its way through court systems about how much, we like that. But it's a fact. It is what it is right now.
It's a fact of what we deal with on a day-to-day basis. We are coming up against a break right now, but anyone who wants to listen to us or ask a question about credit or mortgage, call us at 800-808-5548. We're going to take a break. We'll be right back.
I won't dance. Don't ask me. I won't dance, madam, with you. My heart won't let my feet do things that they should do. You know what?
Welcome back to the Real Estate Rat Pack Radio Show with Chris, Joe, and Rob. The crew is taking your calls, so dial in at 1-800-808-5548.
And we are back. You know, talking about credit. You know, one of the things we're talking about right here is in reference to what your credit consists of, how to establish credit, and how your scores are established. The one thing I want you to talk a little bit about, Joe, is I get this all the time. I don't know why, Chris, you pull my credit score. It's a lot lower than what I did. You know, I went out there last week and I pulled credit through one of the bureaus, and I had a 700. When you're pulling it, it's a 640. And, one of the things you talked about earlier is, all these credit bureaus have algorithms. Mm-hmm. However, there are different algorithms associated with the type of credit you're applying for, whether it be a general credit-based, report, or a mortgage-based credit report, or an automobile-based report, or let's say some type of installment loan, Benbridge, or wherever it needs to be right there. Explain why that happens.
Yeah, this is one of the craziest things. And a couple years ago, when the CFPB was just being formed, myself and a couple of my business partners flew out to Washington to meet with the CFPB. At that time, they hadn't appointed the deputy director yet, Richard Cordroy, but we met with the assistant deputy director, who was at that time the head of the CFPB.
Right.
So I sat there with him and a couple of his staff members for 3 hours while he grilled us about the industry and what all we were doing and how we worked in the industry and all that sort of thing. And it was a very intense meeting to me. Meeting with the head of an organization that's like the size of the IRS, and who have regulatory
which
oversight.
have a lot more power than anybody you could possibly imagine.
Yes, exactly, and who have regulatory oversight over your industry. It's like,
right.
Do I really want to be on this radar? But it was a really great meeting, and they really genuinely seem to be curious about understanding, the hurdles that we see consumers facing.
Right.
And this was one of the issues that we talked about, was that there are a myriad of different scores that you'll see when you're out there as a consumer. You pull it yourself through, TransUnion owns a company, and you don't know it's TransUnion. And
right.
it's privacyguard.com, and you're like, okay, well, it doesn't say TransUnion anywhere on it, but yet they own it. All of the sites where you buy your credit reports are typically connected back to the credit bureaus.
Right.
It's just another way they're making profit off of us.
Correct. Absolutely.
We are the commodity, right? They get paid to collect the data on us, and then they sell the data back to us. It's a great racket. Anyway, so you pull your score yourself, and they have their own algorithm that they run it through, and it produces a consumer-based score.
Right.
And it's still based on the same kind of idea, measuring the various aspects of risk that determine your financial ability to repay a debt.
Right.
But it's their own algorithm. The most common one that is used in the lending corporation is from Fair Isaacs Corporation.
Right.
FICO score.
FICO.
Right. That's what lenders pull. The only place you'll get a FICO score is myfico.com, right, as a consumer. And you'll pay through the nose for it. You'll pay about $60 to get a tri-merge report or all three scores.
Right.
$60. Whereas if you go through any of these different consumer sites, you'll pick up a credit report. We use a company. We use Privacy Guard, for instance. Right. $14.99 for all three. Actually, you can get it for $1 for a 14-day trial period, and then they want to do a monthly, $14.99 kind of thing, which I actually recommend because it allows you to monitor your credit
and
to
the activity
see
associated with it,
what's going on, and whether or not you've had anything new come up. So it allows you to track what's going on. I actually use it for both my wife and I.
Right.
So I do recommend it. But what happens is you end up getting all these different sites have their own scores. And so the consumer pulls a report, and they're like, oh, well, I've got a 700. And then you pull a FICO score, and it uses a different algorithm, and now you're at a 640. And it gets even crazier when they use different score ranges.
Right.
You have a 300 a 350 to a 850 credit score range, but now you go pull a true score, and the true score has a range of 900.
Right.
So, that's where I've ran into people that say, oh, yeah, I had an 870, and I'm like, okay, well, first of all, that's not possible. It's some score model that had a 1,000-point range.
Right.
And when you go pull their actual credit score from FICO, they're actually in the 600s.
Right.
So you have all this confusion. Well, the CFPB, the very first report that they released was on this issue and how it's causing consumers so much confusion that it negatively impacts their credit. Because what happens is they'll think that they're doing a good thing by checking their scores themselves. Now they look like, okay, you know what? I'm in a range where I could go buy that home, or I could go buy that car now. And so now they go apply, you pull their credit, and they're like, oh, look, your scores are not where they need to be. You can't get a home.
Right.
So they end up pulling their score and getting a financial report when they wouldn't have in the first place if their consumer report had been in line with a true FICO score.
And we see that all the time. I mean, it's one of the most common, I would say, misnomers that we see out there is an individual was out there, they looked at some type of credit score, on a free website, myfreecredit.com or whatever it needs to be, and then they come to me and say, I am finally at a level to be able to buy a home. And I look at it and I go, no, you're not. And they said, no, but I just looked at it online. And you know what? Unfortunately, that's the way things happen. I mean, things, the way these systems are set up. And don't get me wrong, I am a proponent of a good credit system. I am not a proponent of a credit system, though, in which you have no ability to impact anything associated with it.
Yeah, the crazy thing about the credit score, even like with the reports thing, is that you end up with even different algorithms based on the type of loan that you're going to pull. So if a mortgage lender, like Chris, for instance, pulls your credit, that score, that FICO score, is weighted towards home loans. And if you go apply for a car loan, the car loan credit score will be weighted towards a car purchase, which from the lending side makes complete sense. From the consumer side, it's crazy and confusing as all get out. Because if you think about the situation with the car loan, the car loan algorithm will weight your credit score more heavily towards how well you've paid your car payment. And so you may be a person, for instance, that pays everything else late, but you pay your car loan on time.
Right.
And so when the car loan people pull your credit, your score will be higher because you have good car payment history.
Correct.
So from the lender side, that makes complete sense.
Right.
But from the consumer, they go and apply, and they're like, well, my credit score when I bought my car loan was a 680. It was great. When I pulled it with you to get my home loan, it was at a 610. How come it's such a huge difference?
Right.
It's
like, weighted associated.
Exactly. And because you're looking at the report and going, well, Mr. Customer, because the only thing you pay on time is your car. So, that's the craziness with the different scoring models. You're stuck in a situation where, from the lender's perspective, they're the ones loaning money. They're the ones saying, hey, I'm the one that really needs to know the score.
Right.
Right. And so the score should be for my advantage.
I would agree.
Then on the consumer side, part of their score, one of the categories we haven't touched on yet, the last category is inquiries.
Right.
10% of your score comes from inquiries. So the consumer's saying, well, I need to know my score so that I don't go and get extra inquiries and arbitrarily lower my score when I'm not ready to purchase.
Right.
So it really is it's a tough dilemma. I see both sides. I understand both sides. From the consumer side, hey, look, I need a consistent score where if the car guy pulls it or the mortgage guy pulls it or the credit card guy pulls it, it's all the same.
Right.
Right. But from the lender's side, I see that perspective too. Hey, I'm just trying to determine the amount of risk this person is because I'm about to give them money.
Right.
Right. And I want to know, want to protect myself. I don't know them. It's not the old school days where, we all live in the same little town and, I know Bob the butcher and, I'm Joe the banker and, I know Bob's a good guy and pays his bills on time. Doesn't work like that anymore.
Yeah, not anymore.
I don't know you from Adam, so I've got to sit down and go, how do I know that you're okay to give money?
And, and one of the things you mentioned, by the way, on inquiries, we see this all the time. Individuals will walk up and say, hey, I want to go ahead and apply, but I don't want to have an inquiry on my credit report. And I tell everybody all the time is, listen, credit is made to be shop. If you want to get good credit, you have to be able to go out there and shop. You have to be able to go out there and have a mortgage company pull your credit report, have an automobile company pull your credit report. It's when all those things are done in conjunction with each other. You're trying to buy a home, you're applying for a Sears credit card for a new refrigerator, and you're buying a new car at the same time. All those factors together are really what's hurting your inquiry line. So a lot of times it's a matter about getting out there and knowing how to inquire, the time frames associated to inquire, and also don't be afraid to look at your credit. Because a lot of times, if you're not looking, as you mentioned right there, you're going to be blindsided when you actually do go out there to try to find something.
Absolutely, and I will say this, which I alluded to earlier, that I myself and my wife both monitor or have an active monthly service where we monitor our credit.
Right.
I know that those scores may be different than what a lender sees, but they typically are at least similar.
Right.
Commonly, they're within 10 to 20 points of what a lender's report will be.
Right.
Plus or minus. They can be higher, they can be lower. I've seen them lower. So you can't take those scores and say these are going to be exactly what a lender sees, and so once I squeak into that 640, I'm going to apply for a home loan. I'm on it. You need to keep a buffer there. But the bigger reason is to be aware of how much your credit debt impacts your scores, that type of thing. And you can see that, if I run up my credit card and I'm using my monthly monitoring service, I will see the score drop.
Right.
I can have a tangible connection to that score versus the amount of debt I have. So when I'm paying down the debt, you can see the score go up and track that history. So it helps you understand how credit works, and it gives you at least some a basis to know what your spending activities and how you pay your bills, those kind of activities, what impact that has on your score.
Right. I would absolutely agree. And, but it's one of those things is you have to be, as you mentioned, a good steward of credit. You have to understand how the credit system works. You have to also understand what your score consists of, and then act appropriately associated with where you want to be. And, and there's I tell everybody else all the time, though, is that if you do the right thing, pay your bills on time, maintain low balances, don't go out there and buy a whole bunch, maintain longevity, sort of like an investment account, right? Invest for the long term.
Yes.
You're going to be fine. 90% of your score right there is covered.
That is correct. There's only, the amount of debt thing is the one that probably sneaks up on folks the most.
Right.
And I know we're coming up against a break. I want to touch on that on the credit card side, because it's one of the areas that even people with good credit, there's behaviors that you can do that will really dramatically negatively impact your credit, even when you think you're doing the right thing.
Well, we will talk about that when we get back after the break. Stay tuned. We'll be right back.
Welcome back to the Real Estate Rat Pack Radio Show with Chris, Joe, and Rob. The crew is taking your calls, so dial in at 1-800-808-5548.
And we are back. Time flies when you're having fun, as we tell everybody all the time. We got 2 more segments to go, but we actually have a caller that actually called in.
800-808-5548 if you want to call in, and if you have a question about credit, if you've got credit issues or questions about how it works, give us a call.
Absolutely.
And we're jumping to...
And right now we have Manuel, actually.
Hey, good morning.
Morning.
How's it going, guys?
Going good.
Good. I don't know if this question's been asked already. I think I tuned in a little late there, but regarding credit repair companies.
Uh-huh.
What do they actually do? How would you fix my credit if I go to you? I mean, it's just so. What's done actually to repair credit?
I think I can address the first part of this, Joe.
Sure.
Which is, everybody asks me that question, and I say one thing all the time.
All right.
Improve My Credit USA.
Yay!
That's just me personally. No, but Manuel, very good question, by the way. We have people ask us that same question, and one of the things, and I can tell you this as a third-party testimonial. I have used a lot of credit repair companies in the past. I have never, ever gotten the service, the quality, and the results that I've gotten since I've started using Improve My Credit USA. And Joe, obviously being one of the founders and owners and chief marketing officers of Improve My Credit USA, can answer sort of what they do within there. But from a third-party perspective, I can tell you is the service that you get, and I appreciate this all the time, is absolutely incredible. From an individual like myself who has to use a service and has to use Improve My Credit USA, it is great to know that I have a good business partner, not just somebody who's out there trying to take care of themselves.
Well, I appreciate that quite a bit, Chris. We have a great staff that does a phenomenal job in supporting our clients. Makes me look good.
Yes.
Lucho
and that's not easy.
Has me covered on the outside, and my team has got me covered on the inside. So, what do you call it? To address your question, answer your question, Manuel. What a credit repair company does, we actually tell our clients this, that all we do is what you can do yourself. And that's kind of shocks people when you hear it. I frequently tell folks that what we do is not hard; it's just tedious and the pain in the rear end. We get paid to be frustrated on your behalf, right? Here's how it works, and it's pretty straightforward. What a true credit improvement company does is, on your behalf, hold the creditors and the credit bureau's feet to the fire and make sure they followed the rules, that they played by the rules. Because everything that's said about you on your credit profile has to be 100% accurate, 100% verifiable within the time frame that they are allowed to report. And unfortunately or fortunately, I don't know, depending on what side of the table you're sitting on, unfortunately, they get that wrong a lot. 60 Minutes did an investigative video back in February last year. They said on national TV that their findings were that 1 in 5 people have errors on their credit reports, and 1 in 10 have serious enough errors that they are causing them financial damage. That was on national TV. The Attorney General for Ohio, in his exact words, in the interview, his exact words were, "I believe the credit bureaus," and he paused and he said, "No, I know that the credit bureaus are violating the law."
Right.
This is the Attorney General for Ohio. It's not like, some, Dan from Dan's Automotive that made the claim. This is the Attorney General for Ohio that stated on national TV, "I know they are breaking the law."
Right.
Right. So, unfortunately, our credit system is in some serious need of improvement. They get things wrong on our credit reports quite a lot. So what a credit repair company does for the consumer is look at your credit, all the items that are reporting. When you have a negative item, the law says that you have the right to verify the accuracy of that item. So I like to tell folks I'm in the truth business. I'm the truth guy. I want to make sure.
You're verifying what is being said is truthful.
Exactly. So
Makes sense.
that's what we do, and that's, for most consumers, they look at credit repair companies, and say, "Hey, I want to pay you to delete all the bad stuff off my credit."
Yep.
And it doesn't work that way, nor do I want it to work that way. I want an accurate representation of the buyer so that lenders are making good loans. That's what I want. And so we sit down, look at that credit report, and then on the consumer's behalf, we go to the creditors and the credit bureaus and say, verify that what you're stating about this guy or this gal is right. It's accurate. And unfortunately, like I said, they get it wrong quite a bit.
Hope that helps, Manuel. Any other questions you got?
Well, I guess it would be interesting to look at that video you mentioned, or that segment from 60 Minutes. I think that's what you mentioned, right?
Yes.
Yeah. It would.
We have it. We have that on our website, ImproveMyCreditUSA.com, and if you put /blog, there's all sorts of neat articles, and that's one of the articles on our blog.
Yep.
Gotcha.
Well, Manuel, thanks a lot for calling, bud. We really appreciate it.
Hey, thank you guys. Y'all have a great day there. I appreciate you.
Thanks
Likewise,
for calling
you
in.
too.
We have another caller.
We have another caller came right behind it. We have Anna, actually, which is on the line right now. Anna, how you doing?
Yep. Anna, you there?
Anna, you there?
Yes, I'm here. Hello.
Hello.
Oh, hi, how are you?
Hi, how are you? I just had a quick question. I had credit cards back in college, which was like 30-plus years ago, and when we tried to get out of debt a few years back, we closed all those accounts, and all we have now is a debit card, and so, of course, that has affected my credit rating because now I have no record of having any credit history.
Yes.
So is there any way to recapture that, or is that just gone for now?
No, it is absolutely a doable thing. The common way let me just say at the beginning of this that I would highly recommend sitting down with one of our credit experts, one of our credit consultants. It's a complimentary consultation, so it doesn't cost you anything. Whether you need us or not, it doesn't matter. We'll look at your situation, tell you what you need to do, give you direction and guidance, and if you do need our services, you're welcome to engage them, but that's not a requirement for the consultation. Mm-hmm. And I'll give you the number right now, the weekend number, so that you can get a hold of one of our guys today. You can reach them at 713-936-0589.
Okay.
And our website is improvemycreditusa.com. Says what we do and where we do it.
Yep, absolutely. But you know, to answer Anna's question,
yes,
though,
to answer that question,
you know, she needs to establish some credit at this point,
right?
Because she has none other than the debit card, which doesn't report out there.
Right. So, how do you go about that?
We thought we were doing the right thing, trying to get out of credit. We paid off all the accounts. All we're using is cash and debit card, but it's starting to affect our credit history because we want to sell our home and get another car and all of that. And I have no record, and I've had credit cards since back in the 1980s.
So this is exactly the scenario that I was talking about earlier in the show. I don't know if you got to hear it. There's some big names out there in the Christian community who kind of preach the whole idea of getting rid of all of your credit cards, unplugging from the credit system, and this is where it takes you. I'm not a proponent. Yeah, exactly. Right. I'm not a proponent of being in debt. And let me say, in defense of this person, because I don't want to, slam them here on air or use their name or whatever. 90% of the stuff they say, I agree with. Right? Oh yeah. I'm a big proponent of being debt free.
Right.
Big proponent of being debt free. I am not a big proponent of unplugging from the credit system and being in a situation like where you're at now, where you're hurt, where you can't get a loan, you can't get a home loan or whatever else because you've lost that credit history.
Well, and there's a big difference about being debt-free and unplugging from the system.
Exactly.
You can actually maintain a credit card. You can maintain items associated that are reporting on your credit and still be debt-free.
Absolutely. Yeah. In fact, if you're really sharp about it, there are credit cards out there that will pay you points, either travel or whatever, but even cash. I had one for 3 years until they quit the program, that for every $2,000 you ran through the card, you got $20.
Right.
Well, I paid all my bills through that card, and then I would just pay the card off, right?
Right.
I paid virtually nothing in interest. I mean, literally just dollars a month. And every year I averaged between $300, $360 that I got cash back on that card.
Right.
So I actually made money using the card.
Absolutely.
Right? So you can be smart about
it. Because, we're starting to look at, buying a car. And
yes.
My credit score, I think, is in the mid-600s, and I know it could be a lot higher.
Sure.
Well, I would definitely say give them a call, sit down, do that consultation. They'll guide you some items right there. There are some things you can do in regards to some secured credit cards that report on your credit. But there's some different items you can come up with right there. And I think every person's situation is different. One of the things we always talk about is we never want to get into personal items on air, and I'm sure you don't either. But there are a lot of things out there you can still do. If you had good credit in the past, right now you don't. You need to establish some new credit. Get with one of the credit individuals over at ImproveMyCreditUSA.com, and they can sort of guide you through some of the short-term changes you can make to be able to have some very good long-term results.
Great. Thank you so much.
Likewise, Anna.
Thanks
we
for
appreciate
listening.
it. All right. Bye-bye.
And that was an exact example of what we spoke about there.
Yes.
That's what ends up happening.
You end up in a situation where in the idea of trying to be a good steward of your finances, you cut these credit cards up, you unplug and all this sort of thing. Yay, I'm doing great. And then a few years down the road, you're trying to buy a car, trying to buy a home, whatever else. And now you have bad credit because you have no credit.
Right. That is correct.
That's what happens.
And there are things, you can establish a secured credit card.
Yeah.
Let's say you have zero credit. We tell this all the time. There's things you can do in regards to piggybacking. There's things you can do in regards to establishing a secured credit card where you put money down on this credit card and it reports to the credit bureaus, but it's essentially you're using your own money to establish a new credit history right there. So there are some things to do out there. And like I said, every person's credit is a little bit different, so that's why it's on an individual basis.
Yes.
But it's definitely attainable.
One thing real quick before we get to the break that I wanted to touch on was how the debt can affect you, right?
Right.
one of the things that folks don't know is that the credit algorithm looks at the amount of debt you carry on a per card basis, not just an overall basis. So what does that mean? Well, every credit card looks at your balance in a 20% increment. So 0 to 20%, 20 to 40, 40 to 60, 60 to 80, and 80 to 100. Each one of those zones is kind of like A, B, C, D, E, kind of a deal, right? The A zone, 0 to 20%. That's where you want to keep your balances, 0 to 20%. Once you cross that 40% line is where you start taking your first ding in your scores. Doesn't matter if you're paying your bills on time or not, your scores start going down. So we're going against the break here. That was kind of the last word I wanted to leave folks with, is to be aware that if you roll all of your debt over to one card because it has 0% interest or whatever, you're wanting to use that to get out of debt, know that if you max that card out, even if all your other ones have zero balances, it's going to tank your score.
Yep, I would agree.
So you have to be aware of that kind of stuff.
Well, we are coming up against a break right now. Last segment online coming here pretty soon. Stay tuned. We'll be right back.
Welcome back to the Real Estate Rat Pack Radio Show with Chris, Joe, and Rob. The crew is taking your calls, so dial in at 1-800-808-5548.
And we are back.
We're back.
Having a good time.
808-5548 if you want to call in. You know, I wanted to finish up that point real quick because it's an area, Chris, that really throws a lot of people.
Right, I would agree.
If it really depends on what you want to use your credit for. If you're trying to apply for a loan and get a loan, it's going to be a different strategy than if you're trying to get out of debt.
Right.
If you're trying to get out of debt, hey, taking all of the money from all the different cards and rolling it all onto one card that has that 0% interest,
right,
so that you're not paying interest and then you can pay it off quicker. That's smart.
Right.
That's 100% smart. Do that. Be on that. But if you're about to apply for a loan, doing that can really hurt you.
Right.
Because what happens is the credit scoring model says, what is the highest percentage of usage, debt to limit ratio?
Correct.
Right. On any card, not just all cards, but on any card. Great. These four over here, zero balance. Great. Wonderful. Oh, wait a minute. What's this one over here? 96% of the limit. That is your ratio, 96%. It doesn't care about the other four.
Right.
And now you're at 96%. That's the worst category, and 30% of your score is determined by that factor, and to the floor.
Yep.
Through the floor your score goes. Right?
I would absolutely
agree.
agree.
So you can spread that out and have it evened out across all of the cards and not even change the amount you owe, but now it's great.
No, I would absolutely agree. I think that's one of the things. So
we got someone knocking on the studio door here.
We do?
All right, what is this?
Who is that?
Hang on, I got it.
Go get it. Go get it right there.
It's Hector!
Hector Villareal.
Good morning, gentlemen.
What have you been up to, buddy?
Yeah, just stopping by the studio.
I didn't know I could
he
knock
was
that
sitting out there
hard.
for a little while. I didn't hear him.
Yeah, he was out there for a while. Wow, the cheese is getting deep in here. Hector Villareal from Lucho, my favorite clothing store in Uptown Park over in the Galleria. How you doing, buddy?
I'm doing well. How are you guys this morning?
Doing fantastic.
Talking about credit.
Yeah.
Let me tell you, I was listening to the radio show on my way out here, and you have given out some very, very valuable information.
Yeah, thank you, sir.
Just in those few minutes that I was able to tune in, I learned a lot, and I fall into several of those categories running a business.
Yeah,
right. Absolutely.
Absolutely.
And it's a good point. One of the things for all those who don't know, by the way, Hector Villareal, he has a clothing store called Lucho. It's an incredible clothing store right there in Uptown Park.
Thank you.
We do a lot of events there. We do a lot of marketing in that area over there with you. And let me tell you, you have just some incredible. Joe's got one of your shirts on today.
It's beautiful.
That is correct. Shoes, the women's shoes that you make are absolutely
amazing.
incredible. Ties and shirts and just a whole array of really good items right there. But one thing we're talking about is credit, and explain to us, because you're a small business owner. You are an owner, obviously, who came here, who has a business, whose credit is very important for your international trading that you do associated with owning the business, especially owning a business in which you have to produce a product.
Absolutely. We design and manufacture our clothing. So we actually have to go out and buy the materials. And that, in order to buy that, you actually have to either come up with a cash, a credit card, or a bank loan.
Right.
So we depend heavily on financing. And listening to some of your comments and some of the people that called in about how to be a good steward of your finances, which I thought was brilliant. And that's what we really have to do. Not only are you trying to market a business, but you have to be a very good steward of your finances. I could not run my business without my bank's help.
Right.
In my case, luckily, we've been with the same banker for about 15 years now, and he knows us. But we're in a very unique situation, and we, in the past, have talked to other bankers where, as Joe said, you don't know. He doesn't know who we are.
Right.
We've been in the community for 25 years. You know I'm a good guy and I'll pay my bills, but this person doesn't know me.
Exactly.
Right.
And those credit lines are important.
And unfortunately, and this is something, and I've said this for a long time, banks are no longer banks. The old day, I grew up in Mexico, and the same thing, we talked about this before, right? It was the old days of the community bank, walking up, meeting somebody,
Absolutely.
seeing that person, them knowing you and your family and your businesses, and being with you through the good times and the bad times. Because let me tell you, this economy, there's always ups and downs. Those bankers are no longer around. Those banks are very few and far between.
Absolutely.
Because the big banks now, the ones that have gotten these big conglomerates that are out there, while they serve a good purpose, they don't serve the local lending market in the way it used to be served. And I will venture to say that a bank has taken risk out of their equation, which is why I don't call them a bank anymore. Because remember, the old banking rules were, guess what? I'm going to go out there and lend money into the community, and I'm going to take a risk associated with that. And with all the financial crisis, they've taken risk out of the equation. They don't want to take anything. It's put deposit in the bank, and I'll lend you credit based upon what you've got in the bank on deposit. Well, guess what? That's not lending. That's not risk anymore. That's a securitization of a monetary means that I have. That's all it is.
That's absolutely right. And we've run into that situation on a daily basis. And anytime we have a project where we want to expand or add another product line, we have to deal with the bank and talk about those situations. Are we going to cut into our cash flow? What are we going to do? How are we going to come up with this money? Do we tap our financial resources like a line of credit or another credit card? And some of our credit cards, and anybody who runs a business knows that you have credit cards with substantial credit limits on them.
Oh, yes.
Yep.
And you must use those.
For our business owners, on that note, since we're kind of talking about this, I'll give a perfect example. When one of my first clients early on was a couple guys that owned a ticket sales company. They were a ticket sales company, a Ticketron kind of place, right?
Right.
And they were wanting us to work on their credit, look at their credit, because they had some dings and stuff on their credit that they were concerned about whether that was being reported accurately. And we looked at that and said, yeah, that's absolutely something we can work on. And they said, once we got into it, they're like, well, something I don't understand is why our credit will take such a huge swing from month to month. 1 month we'll have a really, high score, and then next month it'll drop 60, 70 points. And, so I'm like, well, let me see month to month what your reports are showing and what you've got going on. And we would look at a couple of months, and I'm like, well, there's nothing, dramatically different. Wait a minute. Your credit cards here. Tell me about your credit cards and how you're using your credit cards. I see you've got a couple different personal credit cards. They were taking their personal credit cards, and they would buy huge stocks of tickets. And they would max out the credit card and then sell the tickets. And as they sold the tickets, they would pay off the credit card. And they paid off the credit card every month.
Right.
Right? So they're like, well, I don't understand. We pay it off every month. But what happens is their reporting date and the date that they had to pay that bill were two different dates. So what happens is your bill's due on the 15th, but your date that credit card reports to the credit bureaus may have been the 7th. And so what happens is your credit card's maxed out on the 7th. It reports to the credit bureau. You're maxed out. You pay the bill off on the 15th. But for that whole month now, before the next reporting cycle comes around, it's reporting that you're maxed out on your credit cards.
That is correct.
So if a lender pulls that credit report, boom, your scores are tanked because your credit card's maxed out.
Right.
So if you're a business owner that's using a personal credit card as part of your funding for your business, which that happens all the time.
Absolutely. Right? There are very few people who cannot be in that situation.
Exactly. So if you're a business owner with a personal credit card, especially in the real estate industry, you have contractors and that type of thing who use their credit cards and credit lines for jobs so that when they complete the job, they turn around and pay that card off. If you're in that situation, you need to be very, very aware that your balance may be reported to the Bureau at a different time than when you pay that bill. And so it behooves you to get a hold of the credit card company and ask them what the credit reporting dates are for your card.
And, and one of the worst ones that we see from a mortgage side of things is American Express.
American Express, yes.
American Express, absolutely one of the worst, because a lot of times what happens is the following. American Express, for example, is the majority of people, they pay their bills.
Yep.
At the end of each month or whatever that time frame is. The problem from a credit reporting standpoint is if you went out and spent $15,000 this month, it shows you have a $15,000 balance and a balance due of $15,000, right?
Yep.
So you come to me and you say, I want to get a mortgage. And I look at that mortgage and I say, okay, guess what? You got an American Express bill now for $15,000. And they say, yeah, but that gets paid off at the end of every month. From a mortgage standpoint, I have to then make sure you have enough funds as part of your closing to have in reserves to pay off that $15,000. And also from a reporting standpoint, it varies. So you spent $15,000 this month, you paid it off in full. Next month you did $35,000. You're still going to pay it off in full, but guess what? Now it shows that you maxed out to $35,000.
Yep.
So you have to really understand how different credit works because not all of it's created equal.
Yep, very much so. Well, we're down to the last few minutes. I want to make sure we, since Hector stopped in here, Hector, tell folks how to find you and how to come visit the shop. I know I'm there on a regular basis, so our audience might have a chance of running into me if they
I would highly suggest getting over there. That is correct.
Yes.
Well, thank you. We are in Uptown Park, the Uptown Park Shopping Center that's located at 610, and that's South Post Oak and 610. And we've been there for about almost 14 years there. Like I said, we design and manufacture tailoring clothing for men, and it's a custom clothing shop as well. And we've now started with women's shoes, and we have a line of women's shoes, which absolutely every woman that I know loves shoes.
Yep. They fit me great, by the way.
We have several of our Rat Pack alumni.
Yes.
Nicole, if you're out there listening, Nicole has. I ran into her there a couple weeks ago. Lois De Armas has a pair. Yep. Teresa Kennedy.
You guys have been great at bringing folks out there who haven't had the opportunity to meet us and know what we're about, and we're involved in the community, and we just feed off of each other's energy.
Well, no joke. I have 4 or 5 shirts now from your shop. Every time I wear them, 100% of the time that I wear them. In fact, one of the managers here, station manager, said made a comment about the shirt. Said, "Joe, I love that shirt. I have to start calling you Joe GQ."
That's awesome. I love that.
And no joke,
GQ Joe.
GQ Joe.
There we go. We just changed your name.
Yep, there you go. So, every time I wear one of your shirts, I repeatedly get compliments on it. I love y'all's stuff. You make amazing clothes. And my wife doesn't want me to go by your store anymore.
Well, we tell everybody, get out there, go visit. You can have a good drink on him. And more importantly, get dressed up. We talk about dressing for success. It's a great area to do so.
Every realtor needs to stop by his shop.
I would agree. One of the things is we always say every single week we end with a good quote. And this is actually no different, except this one actually has a financial twing to it, by the way. It says, some debts are fun when you are acquiring them, but none are fun when you set about retiring them.
Oh,
pretty interesting stuff right there, isn't it?
Yes.
If you want to hear more about the Real Estate Rat Pack, go out and visit us on the web, realestateratpack.com. Until next time, we are going to be out.
And you've been listening to the Real Estate Rat Pack. The question is, who's Frank, who's Sammy, who's Dean, and who's the other guy?
Chris is Frank, he's Dean, and I'm Sammy.
Yes, that's right. Yeah.
So tune in to the really big show every Saturday at 9 a.m. right here on 100.7 The Word, KKHT.